stocks. Ed Yardeni is president at Yardeni Research. He's joining us now to take some questions. Yeah, Ed, good to have you back on the program. Thanks very much for your time. There is constant pushback to, don't expect the first rate cut in March. Overnight, the statement on the balance sheet. So is this just the Fed trying to temper expectations here a little bit? Markets paying no attention?
I think so. I think you're right to ask the question, because the markets have been discounting 4 to 5 rate cuts this year, starting in March. And I think Fed officials would rather stay very flexible and stay restrictive as long as they can, because the worst case scenario for them is that they ease too much too soon and inflation makes a comeback. So as long as the economy remains resilient, which it seems to be quite resilient, I think the Fed's going to hold off on lowering interest rates too quickly. And I don't think we're going to have a rate cut until the second half of the year. I think maybe we'll get 2 or 3 rate cuts, maybe.
2 or 3 rate cuts, maybe. And this is when markets were expecting 6 as we rolled into 2024. Ed, good morning, or rather good evening your time. Thank you very much for joining in.
Sure.
Let me ask you about the other development on the crypto side that happened. And I'm asking this because I want to know if it could potentially have any impact in terms of money flows from one market to the other. What did you make of this ETF approval? It was always going to come. I think that was the expectation. But then the statement seems to still sound a bit hawkish on this asset class as a whole. How do you read it? And do you expect any impact on money flows between cryptos, bonds, and equities?
Well, I think the government is kind of torn about what to do about Bitcoin. I think if they had their way, they would prefer no cryptocurrencies at all. It's certainly a competition for the Fed. It certainly provides a payment system for illegal activities. And so I'm actually quite surprised that they've gone this far in terms of, basically saying, giving their blessings to an ETF. But I think they're going to be monitoring it very, very carefully, as they should.
Hi, Ed. Morning. Good to see you, Ben. Ed, what do you make of the Asian market screen, though? India's done pretty well. Japan, out of nowhere, has come back, multi-year highs out there. And the Chinese market continues to struggle. How do you read the Asian markets?
Well, I think a lot of money that might have gone to China is going to other Asian countries, for sure. The Chinese market's been doing terribly because the Chinese economy is doing terribly. And I have a chart that one of these days maybe we can show on the program, which shows the MSCI for China versus the MSCI for India. And it's startling what a divergence there has been in recent years. So I think this clearly indicates that China is no longer viewed as a emerging market that you definitely have to own.
No, and we love to see that chart. Although I must say that that comparison is, I think a lot of our audience has said we've shown that chart in different ways, not the MSCI one, but it's remarkable, right, as you put it, over the last, and it's not 5 years, 10 years, it's 20, 25 years. Although, Ed, to that point, Akash Prakash, who's an old-time, he was ex-Morgan Stanley, runs his own fund, Amansa Capital, well-respected figure. He wrote a piece here recently, making that very comparison, but drawing a different conclusion. His point was that don't confuse GDP with what stock markets do. He cited the example of China. China was, of course, this economic miracle, and stocks have performed very poorly for 20 years, right? And he was kind of asking the question whether in India, growth will be strong for many years to come, but have we borrowed from the future in terms of stock market returns? Just your thoughts there, Ed, briefly.
Well, I think the prospects remain very good for India. It's clearly, compared to China, it's a much freer economy. It's a much younger economy demographically. And there's a lot of onshoring going on, meaning that a lot of companies are leaving China, looking for other places to do their production and their business. And I think a lot of companies went to China thinking that is market of over 1 billion people and they should be able to make a lot of money. But it turned out that the regulatory environment was very, very restrictive. And so suddenly, not suddenly, but over the past several years, people have come around to recognize that India is an excellent alternative to China. And that, again, China's got an economy that's probably structurally in trouble for a while.
Hey, all right, Ed. Before we wrap up, I just want to point out an update that's come in. Now, there's something we'll be talking about tomorrow because, we'll start getting a lot of the big bank earnings in the U.S. And this is just out. Citigroup has just given out an investor warning ahead of its Friday results that some of the charges that it has to take on, currency issues with respect to the peso and the bank's restructuring, they could be huge, far higher than what Citi had earlier indicated. Citi could report a loss. That's not what markets will like to hear. And very quickly, as we roll out into the earnings season, I mean, overall on the U.S. market in the short term, are you optimistic? And how are you viewing some of these?
Okay. I am optimistic. I think Citi's an outlier.
Okay. All right. I just had to get that clarity from you. Thank you very much for joining in. Good talking to you as always.